Mhm. Good morning, Shell. Good morning, Miss Nieesha.
Good morning.
Good morning.
Good morning, Angel. Good morning, Amanda. Good morning, Derek.
Do we have Smiling Doll today in office?
Yes, ma'am.
Okay.
We do. My mornings is still off. Um,
Yeah, you was up grinding all night and morning.
yeah. And then I messed around and woke up early this morning. I don't know why. I'm still working, but I did get to catch up on some files. So I will be back at it again today. We also got contracts class today. So, guys, we're going to get started here shortly. Does anyone have anything they want to speak about before we get started this morning? Any questions? Anything? Good morning, Miss Kayla. Good morning, AK.
Morning.
Hi, and good morning.
Okay. We will get started. Miss Nieesha, how you doing?
Janelle, I am fine and dandy, still very pregnant.
Oh, yeah,
So
I
y'all
know.
just y'all just bear with me. I've never experienced pregnancy fatigue and insomnia. It's a new world. I'll just tell you that.
Well, welcome to real estate too. It's gonna be
Yeah.
welcome to real estate. So, we'll get started here. On time today. I do have a few questions for you. I want you to wait just a little bit after everybody kind of logs in to tell us about your new products that you have going.
Okay.
But I did a little research on the real estate market, so I do have some questions. These are just opinions, y'all. This is a good opportunity to ask questions and have a really great conversation. The reason why I did pick Nieesha for this conversation today is because I love her energy and her dedication to the mortgage world. So she will probably be one of the best people to answer these questions because she doesn't just do her job, but she does a lot of research. So even though she took my advice and left me, I miss her.
Janelle, you give out good advice.
But looks like sometimes it bites me in the butt. So how are you liking it?
I really love it. When you move into a different company, a different position, you learn different things. So the expansion of knowledge is what I'm really enjoying right now. How they kind of navigate through their loans and set up everything, I'm really enjoying. And the culture of Cornerstone is everyone is dedicated to getting the mortgage done. So it's been a really wild ride. But mind you, that I'm used to doing a certain amount of volume. Um, and then I took that volume, but I didn't take my assistant, and I'm pregnant. So bear with me, everybody. It's great.
Oh wow. So they didn't give you an assistant?
They asked me if I wanted to take my assistant. It's hard, y'all, to find assistants that are good. So I don't know if anybody else struggles with that just in real estate in general, but it's very hard to find good assistants, and usually they don't stick around long. So when they asked me if I wanted to bring mine along, she couldn't come because she wasn't licensed. And so now I'm about to be on the hunt for a licensed assistant. So if anybody knows anybody who wants to get into the mortgage world, I'm really wanting to mentor someone to become a loan officer in the long run, if they so choose. Um, and that way they can grow their own business.
I actually do have someone that wants to do it, but they've taken the test twice and they're discouraged. But I will.
Mm.
I really didn't know that in the mortgage world, you can only take the test every 30 days.
And if you fail it the second time, then they make you wait. I think it's either 90 days or 6 months or something. It's something weird.
Oh wow. Okay, guys. So my question is, I was reading some articles. I do a lot of reading. So I've seen three different perspectives of what the mortgage world is going to, what they're predicting. I've seen NAR's perspective. I've seen Fannie Mae's perspective, and I've seen Freddie Mac's. Now, Fannie Mae and Freddie Mac both believe that the interest rates are going to get to about 6 to 7% by the end of 2023. But there's still a really good time to buy. All three of them do agree that we are still at where we're supposed to be, still at a historic low, because real estate goes in cycles. So everything that goes down or everything that goes up must come down, right? But NOR had a really good perspective about it. So the economist that spoke on the HAR report said that one of the things that they're doing with raising the interest rates is stabilizing the market and bringing back the inventory.
Mhm.
What do you think, Nisha?
I absolutely agree, right? Because at first there was a rush for everyone to get into real estate, right? When the market dropped and everything was 2 or 3%, we see a bomb rush of people coming um, into the real estate market because people who could not afford it first can now afford. And so everyone, y'all saw it where agents were receiving 50 offers. Builders couldn't keep inventory on the ground. They were already under contract and they hadn't even had foundation. They were dirt. You know how many dirt contracts I saw last year that took anywhere between 6, 9, maybe even 10 months to build because supplies were low and everything else. But now it's getting quiet. Even some of my fellow loan officers were kind of talking about it and we're like, yo, it's eerily quiet. Now, thank God in my world it hasn't gotten that quiet. I'm still producing and bringing in about the same amount of business that I would expect for this time around. But now my builders have inventory. And
Mm.
because builders have inventory, they're getting creative because you can't keep inventory on the books, right? Builders have to make a certain amount of revenue and they have to hit numbers by the end of the year. And so now, I'm talking to my builders. Of course, I work for David Weekly. I still have connections over at Chesmar. I talk to some other builders who might be a little bit smaller, and everyone's saying the same thing. We've got inventory and we have to sell. And people do not care about purchase price. I want to put that out there very clearly. People don't care about purchase price anymore. They want to know how much is their monthly payment. And that's where the mortgage side comes in because you need a good loan officer to really break down to people how they can get into the market and afford the payment for this home that they want. They do not care that the home is 400,000. Builders aren't even saying we'll take 15,000 off the price anymore. They are offering incentives for you towards closing costs, towards other things because they want that payment as low as possible.
I'm glad you brought that up too. I have noticed it's been one of those things, and loan officers always tell me that they can't post. What's the rule? They can't post interest rates and they
Uh
can't
huh.
post payments. But lately, I have seen them break it all the way down. If you make this, this is what your payment will be.
Uh
This is
huh.
this. So, how are we breaking this rule, and what exactly is the rule?
Okay, so the rule is Consumer Financial Bureau, pretty much, Protection Bureau, pretty much tells us that if you disclose an interest rate, 4.99, 3.99, whatever the case may be, you have to disclose the APR and the terms of that loan, right? So we have to disclose that what the APR is. If y'all don't know what an APR is, it's truly the closing costs plus the interest rate um, exposed as a percentage. That's all it means, right? So if someone is offering a 4.5% interest rate, but then the APR is 6.5, what you can guess in your head is that those closing costs are high. And the reason why those closing costs are high is because they're paying discount points to get a 4.5. Okay. That's the secret method, everybody. Um, and then we have to disclose, what kind of loan program, what are we estimating for credit score? So there's a lot of things that you truly have to disclose if you decide to put a number on paper. If you put a number on paper, we have to disclose certain things. And if we say like we have the best product for you, there are triggering terms that could get us in serious trouble
Hmm.
if we decide to advertise. Certainly. So yes, Janelle, you may start to see loan officers get a little more creative because we understand that people really want to understand what the payment is. But we have to be very, very careful because they are watching us like a hawk and making sure that we're not advertising something that can't be done.
Okay. So what do you feel what is the interest rates now, and what are the creative products that you now have? Now you can let everybody know what products do you have and what's the creativity in this mortgage world right now.
Yeah. Um, so interest rates right now are around in the current market at a 30-day lock or around 5.875 for an FHA, around 6% to 5.99 for a conventional loan. Okay. I've had so many clients call me and say, Nieesha, I saw 5.3, 5.6. I can offer you 5.3, 5.6. Just know that it's going to probably cost you more than anything, but it is a possibility. And so with all that being said, what's the creativity right now? Well, my job as a loan officer, and I ask every client, what do you want your monthly payment to be? Okay. What do you want your monthly payment to be? Because it people care about rates, but they think they care about rates. I want to be very clear about that. They think they care about their rates, and they do. They want to make sure that they're not getting junked around, but really they want to know, how much am I paying every month? If you can translate what an interest rate does to a monthly payment, then people will, oh, I hear it all the time. Oh, I didn't realize that, right? So now it's my job to make sure I understand what your monthly payment is going to be, what your rate is going to be, how long is this going to be your rate. If y'all haven't started seeing it yet, you're going to see every loan officer, including myself, start to say, marry the house, date the rate. Marry the house, date the rate. Marry the house because this is the house that you love and you really want to be in this house and this is going to be your home. Date the rate because this rate will not last forever. If rates drop back down next year or in 2 years, I'm just building up my refinance pipeline. And I understand that. And other loan officers understand that. So in regards to getting creative, right now, I've got a couple of things. I love 2-1 buy downs. If anyone hasn't heard of a temporary buy down, that's a really good offer. Okay. And if you don't know what a temporary buy down is, it's different from a permanent buy down. Okay, a permanent buy down means that you pay discount points at closing in order to get a lower interest rate. So, for example, you bought your interest rate down from a 6.5% to a 6%. You ended up paying $1,500 at closing. That is a permanent buy down. A 2-1 buy down or a temporary buy down or a 1-1 buy down means that you're someone is paying the interest up front for you and you get a lower interest rate for the first 2 years until year three. Okay, so what do I mean by that? If you lock in at a qualifying rate of 6.5%, and you someone offers a 2-1 buy down, essentially you would get a 4.5% for the first year, a 5.5% for the second year, and for years 3 through 30 it would be 6.5%, the qualifying interest rate. This is not an arm. It will not adjust for the life of the loan. It will, however, it will um, it will stay steady and you will have a lower interest rate for the first 2 years until year three where it's finally fixed. There's something called a 1-1 buy down as well, right? Meaning that a buyer could essentially do a 1-1 buy down. And the first year it would be 5.5%. The second year it would be 5.5%. And the third year it would be 6.5%. And the same for years 3 through 30. So again, a really good program. Why would someone choose a 2-1 buy down over a 1-1 buy down or opposites? They cost differently. Okay. So for all the listing agents who are looking for a way to incentivize um, and get people to buy the home, and maybe you don't want to lower the purchase price, y'all need to work together, and maybe do talk about concessions, but get with a loan officer for somebody who can offer a 2-1 buy down, right? Because truly the seller needs to pay for this option. If the buyer does it, it's not, um, it doesn't really reward them in any way because you're paying for the interest up front. But if the seller pays for it up front, then the buyer wins. They get a lower interest rate and they can walk away, knowing that they didn't have to pay for it. Essentially, the seller paid for the concession up front. So you're going to see a lot of builders start to do this as well, right? And we offer it with builders. They could do this. They could buy out mortgage insurance, lock your rate for a certain amount of days. They're doing so many things to get that payment lower because at the end of the day, everyone is trying to get a home sold.
Oh man, that's pretty good. I'm glad you explained. I've had several builders tell me, or and several loan officers come to me and be like, okay, so we have this interest rate, and they have the first year is 4%, second year is 5%, then it bottoms out at 3. That's all they say. So understanding it from the perspective, the way you explained it, makes a world of difference. Why? Because as a real estate agent, and we're having contracts class today, right? I would approach the contract writing different. Tell me if I'm wrong. But if I was an agent, I'm not going to write the closing costs for the standard FHA, what is it, 6%,
Mm-hmm,
VA, 4%,
mm-hmm,
and conventional 3%. I'm going to call the loan officer and I'm going to say, hey, how much is it going to cost them to buy this down? Because
mm-hmm,
that's what I'm really looking for. That's
mm-hmm.
what's going to save them in the long run because the interest is the interest. That's what it is.
Mm-hmm.
So we're gonna tell people you should have money for your closing costs because
Mm-hmm.
you need a different closing cost right now. We are shopping price. We tell people to call your loan officer and ask how much would it cost for you to buy. What would your payment be on this house versus what your closing costs and down payment would be? I think we would have more educated buyers. What do you think?
Agreed. Agreed, right? Like, because last year in the market, I would tell you that closing costs are important because rates were low. And so people needed something to spend money on. So, of course, they want to bring the lowest cash to close at the table, which is still important. But right now, because rates are a bit higher and these homes are a lot higher, my monthly payment means a lot more. I bought my house in September for 350 with a 3.25% interest rate. My payment is pretty good. Well, now my same house that down the street costs 460, and the rate is different, and the payment is going for 3,500 or whatever the case may be. Excuse me. A client is looking at that, and that's where you're getting like unsure buyers where they're walking away from deals because they're like, I don't want to buy that anymore. That's not what I started off with. So I agree, and it is definitely a good way to get creative with your loan officer as you're calling them, and you're trying to work out concessions for your buyer. And hey, what can you offer me? Well, they want a lower rate. Can you offer this much in concessions? And the loan officer can tell you how much to put on the contract so you can ask for the right amount, and they can use that towards buying down the interest rate.
Okay, so you guys should really have some questions right now. And I have one more before I let you guys ask a question. What does that look like? What does a credit profile look like for that product? And what is the does the lender what kind of programs can they add on top of that? So could they add DPA? Could they add lender credit? What does that look like? What's the process like?
Gotcha. Okay, so a 2-1 buy down can be used for most programs, y'all. Meaning FHA conventional, and I believe VA can do a 2-1 buy down as well. The only product that I haven't seen it as popular on is a USDA loan. Excuse me. And I, Nieesha, am not an expert on USDA, but I am now surrounded by other loan officers who I talk to, and they do USDA loans. And they're like, yeah, it just isn't as marketable in that area. But for everyone else, a 2-1 buy down is a good option. Now, Janelle, you asked, like, what else can they place on top of that? When it comes to a 2-1 buy down, you can't put down payment assistance. And here's the reason why. When you put in down payment assistance, you fix that buyer to a certain interest rate based on the program. So the 2-1 buy down is truly a program on its own, and the down payment assistance program is a program on its own. Because down payment assistance tells us as the loan officer what we can offer. So if we're trying to get a 3% grant for the client, then DPA might say, okay, well, you can offer a 6.5% interest rate based on today's market, or 7%, or whatever the case may be. So 2-1 buy downs aren't good for that. Lender credits, on the other hand, because you're getting so much in concession, it's usually we can't offer as much of a lender credit, because there's already credit coming in. So that's where it gets a little hard. But in regards to how does this benefit both parties, I would tell you that the seller at this point knows that they're going to sell the home at the price that they truly want, but they might have to offer some concessions. It's really not a topple on program. It truly is a program where, hey, we buy it down, we keep it here, and we make it happy. And it is a very popular program, that I'm pushing to clients more and more, aside from buying out their mortgage insurance, which is also a really good option if they want to keep their payments a little bit lower. Now, the only problem with buying out your MI is you can only do it on conventional. You can't do it on your FHA loans. Only on conventional, and VA does not have MI, so you don't have to worry about that.
Okay. You guys have any questions for Nieesha? It'd be a great time to get you some mortgage questions to ask.
Yeah, this is AK. I have one. Um,
Yes.
I actually had this aha moment last week, and I tracked down a graph to kind of show the difference. And one of the things that of course, there's a lot of variables, but pretty much essential. They said by buying down the points on this particular scenario,
Mhm.
instead of dropping the price 10,000, you give them so much, buy down at least a half a point, and over the lifetime of the loan, it saves them like $50,000.
Yep.
Yeah, so I thought that was pretty interesting. So, but here's my question. So is that 3-1-2-1-1-1? Is that that's different than me as a seller giving up concessions and buying down a point, correct?
It's really the same thing, same concept, right?
Same concept, but
Same concept.
could I do it on top of whatever loan program they have? If I'm the seller and we still had a situation and I need to bring down the point some more instead of giving them concessions, buy down a half a point.
Explain what you mean by that,
So
because go ahead.
So say they got the 2-1 program already and they brought the
Mhm.
interest rate down some. Could I, as the seller, and say they still come to me asking me for seller's concession, can I, in lieu, still pay down a half a point on top of that 2-1 program they got?
It depends on how much concession they have.
Oh, okay.
Because everybody has seller contribution limits. So,
Hmm.
like, depending on the program that they are qualified for, whether it's conventional or FHA or whatever the case may be, that there's contribution limits on there. So if you hit your, because this program is not, it's not cheap, y'all. It's usually a bit more costly, but worth every dollar, because at the end of the day, the buyer wins, the seller wins. This is kind of my creative strategy. If you wanted to keep your seller's purchase price at a certain point, but and they wanted to sell the house at that certain point, but they didn't want to give up too much else, they could give those concessions. That's what I've been kind of telling my agents. So yes, you reach a contribution limit based on how much the down payment is that they're providing on the home and things like that. So just keep that in mind.
So it's a conversation with the loan officer.
Absolutely.
I always suggest that we have our conversations with our loan officers before we begin to even show property, so that we can together build a strategy. But it's even more important now to have several conversations throughout the contract writing process, because this is a strategic process more than it is a qualifying process right now. Everybody you're going to be talking to that can get a pre-approval letter, they qualify. But right now we're trying to figure out what's the best way to get them into the property that they want. And I do love the scenario to marry the property and date the rate. That's good.
Mhm.
because one thing about it, the availability of a house is going to be the availability, but the rate's going to go up and down. So can we refi? Can we do some other things later on in 6 months to a year to make this more favorable for you, and you just ride this ride for a little while, which makes a lot of sense.
Yes, exactly. Exactly.
Nieesha, this is Monica. I have a question. I got two questions.
Yes, ma'am.
What's the maximum amount that a lender will provide a lender credit?
Okay, so when it comes to lender credits, that usually comes from the market. And does everyone know what a lender credit is and how we get to one for the most part?
No.
No.
All right. Okay. So lender credits usually, a lender credit means that I offered you a higher interest rate in order to get a credit at closing. Okay. That's how lenders give away lender credits. We truly don't have the ability to just, because we can't give up commission, right? Legally is truly not an option. Not in that realm, but in order to give a lender credit, we offer a higher interest rate to take a credit. I tell people all the time it works the same way with down payment assistance. As down payment assistance, you're just not getting as high of a credit because it's usually not 3% or 4% or anything like that, like you would get with DPA, but it might be like 1%, 1.125%, 1.5%, and that can still add up depending on what the loan amount is, because it's based on the loan amount. So your lender credit is based on a higher interest rate and it's based on the loan amount. I hope that makes sense to y'all. Um, so that's what a lender credit does. I usually offer lender credits to clients who they're interested in down payment assistance, but maybe they don't want their DPA, their interest rate that high. Okay. Maybe they're arguing me down because they're like, nice, I want some credit, but I don't want 7%. Okay. Well, if the market is offering um, an additional $2,000 for her to take 6.5 instead of a 6.125, and the payment is only going to be a $50 difference, I'm going to sell her on a lender credit every day and say, hey, this might be a better option for you instead of you having to take a higher rate in order to get such a large percentage. So lender credits are definitely an option. It usually does not affect the loan officer. It's going to affect the client. And if you need a mortgage calculator to kind of figure out if if taking a higher interest rate is going to make a huge difference on their property or their monthly payment, then I'm happy to give you mine, because it is a good tool to use. So then you can even show the client, like, okay, if you take the 6.5 versus the 6.125, it's really not making that big of a difference.
Okay, thank you for that. And um, what's negotiated when lenders decide to do payoffs of like the debt to make them eligible for the loan?
What's negotiated
Yes,
with?
like what's the discussion like? Um, is there something that's offered by the lender, or is the client saying, well, can you pay off this debt so that I can be eligible, or the lender is saying I can pay this off for you?
No, it's usually the client. We can't pay off debts. There's no way around that. We cannot pay off debts. You got a lender that can pay off a debt. Let me talk to him. I got questions. Um, but what we can do is advise your client, like, hey, listen, I've got a client right now. She's trying to get approved for a $450,000 house. She's got a credit card that has a $200 monthly payment. Okay. And so on my back end, I see that this $200 payment, if she were to pay it off, it changes her debt to income ratio. She would now qualify for the $450,000 house. So usually when a lender asks for a client to pay off debt, because we really do not care how much debt you have, okay? I do not care how much debt you have. I care if you qualify for the mortgage that you're looking for. And so if a lender is recommending for a client to pay off debt, 99% of the time you can bet that they do not qualify for whatever home that they're trying to qualify for or whatever amount that they're trying to qualify for with this debt. Even if paying off all debt still doesn't get the client qualified, then that's not a issue at that point. It's usually an income issue. Okay, because I've had realtors ask me that. Well, can they pay off all debt and still get approved? Well, if Sally's making $4,000 a month and the mortgage that she's looking at is $2,200 a month, there's not enough debt for me to pay off to get her qualified, because 2,200 divided by 4,000 is still going to be whatever high percent. I know it's over 50%, and you can't use over 50% of your income towards buying a home or paying for a mortgage. The system will not allow it. We can get it down, but we can't do anything. So then we might say, hey, it's time for you to get a cosigner, or let's looking at a lower priced home or other options.
Makes sense. So, because I had a client that um, it was, they lowered her amount for her loan with
Hmm.
paying off her debt. So that made her eligible for the loan,
Hmm.
but it was her paying it off at closing when she had her closing costs.
That's right. Hmm. Yes,
Okay.
ma'am.
Hey, Nieesha, it's Maze. I have a question for you.
Yes, ma'am.
Um, what if a client had a home, they fell into forbearance, so then they sold it? Is there a certain amount of time that they have to wait to be able to qualify for a new home after that forbearance, or how does that a forbearance affect them trying to purchase in the future?
Forbearance is different than foreclosure. Okay. Um, So foreclosure is the word that I look for. Foreclosure is like a derogatory term, because if you have a foreclosure, there's a waiting period. In regards to a forbearance, as long as the loan was paid off in full, or they started back on active payments and it wasn't shown as late payments on the credit report, then they should be fine. Um, so please keep that in mind, that forbearance is different than foreclosure.
Oh, that was good.
I have a question, Nisha.
Hmm.
So most of the clients that I've been getting, their main concern is the monthly mortgage. So when we talk with the loan officer,
Hmm.
or they talk to the loan officer, is it best that we tell them to tell the loan officer what how much they want their mortgage payment to be, and then that way the loan officer can let us know how much to look for? Because like I'm looking for homes that they qualify for, but it's over what they want their monthly mortgage to be.
Okay. This is my favorite conversation, because it's not hard, it's just layered. Okay. And the reason I say that is because there are different layers that go into your clients in their purchase price and their mortgage payment, which which I'll get into. So let me explain. Let's say your client is approved for 300,000. Okay. And then they start searching for a $300,000 home. Y'all send the home and property over to your loan officer. You send it to me and you say, hey, Nieesha, run the numbers on this $300,000 house. I come back and I show a payment of 2,800. Um, but your client was looking for a $2,500 payment. And it's the reason why over time I stopped sending out estimates until I had a property. I'll send you a pre-qual letter. Yeah, you approved for 300,000, but I won't send an estimate until I have a property, because people might, if I'm showing that the taxes are lower or the homeowner's insurance is lower, then they feel fooled by the time they get back to me and they're like, well, Nieesha, I thought you said it was going to be 2,500. Please remember that every single property is different. So if you're looking at a $300,000 home that has a tax rate of 3.5% versus a tax rate of 2.5%, that's going to modify your monthly payment. Your principal and interest will stay the same. I can guarantee you that, because if the interest rate is the interest rate, that's not going to move. But taxes might change, and that could change the monthly payment. The homeowner's insurance could change, and that could change the monthly payment. And so you can tell a loan officer, hey, this is what I want the monthly payment to be. But it is really important for you as the realtor to work with the loan officer so y'all can um, really break down what the numbers are on a specific property. So then that way the client feels comfortable with whatever they're looking for. Does that make sense?
Hmm.
Yes, ma'am. I just try not to, bother the loan officer so much because I know they have other clients. But
Hmm.
when you have when you have a client that's interested in like two or three homes and kind of want to know the mortgage,
Hmm.
because we're kind of like on a time restraint because homes are flying off the market still.
Hmm.
So if we see something, we really need to put an offer in that day. But I'd be worried to put an offer in not knowing how much the mortgage payment is going to be.
I love what you said there, Shell. Shell, can I ask you a question? Do you take your laptop and your computer when you go out on with clients?
Yes, ma'am. I take my whole house with me.
Okay. So, shameless plug, y'all. I have a really good mortgage calculator. Okay. I sent, I put it in the chat and I dropped the actual app. Okay. I dropped the app that is going to show my face. I'm real proud of my app. I like that app. But there's an app that you can use that, let's say you were out there shopping and you want to bring up a calculator. If I told you on Friday that the interest rate was, 6%, and y'all can go out there and shop, you can open this calculator and you can actually input the taxes. You can input, what you are figuring for your homeowner's insurance to be for that property, and it'll give you what the actual payment will be for the property. You could do this on your laptop or your phone, right? So then that way you don't have to bother the loan officer. I've actually been real pleased with the calculator because 9 times out of 10 it's been spot on. So please keep that in mind. And the other good thing about shameless plug, my company, is that you can get an updated pre-approval letter and you don't have to call the loan officer. So let's say your client gets approved for, again, 300,000. Y'all are looking at a $285,000 home. You're out there shopping and you're like, dang, how much is this monthly payment? Okay, hold on. Let me get the calculator out real quick and let me run Nieesha's calculator. Okay, this is a good payment. You like this payment, Susie? Okay, this is what we're estimating the payment to be. But we need a $285,000 pre-qual letter instead of a $300,000 pre-qual letter. Susie can go right into her borrower portal and actually pull in a 200. She can modify the payment, the purchase price down. Once I give her a max purchase price, she can't modify it up, but she can modify it down, and now she's got a $285,000 pre-qual letter. So life just got easier for you as the realtor. She got a new pre-qual letter. She knows what her monthly payment is. She's interested in the home, and you never had to call your LO.
Oh, I like that.
Me too.
And can
Thanks.
she give me her password, or do I have my own password?
Janelle, you can talk to your client and make arrangements however you see fit.
Oh, okay. All right. Because she might not understand, and she at home trying to have a whole conversation. I need the prequel right now.
Mhm. Yes, ma'am. You have access to that. So and she does too. So it's kind of nice to go ahead and just pull in a new letter.
Okay, I like that. Now, the way I think may not be the way a lot of people think, but if you can tell me as a loan officer the principal and the interest, most of us just got out of real estate school, so y'all do know how to calculate PITI, right? I'm assuming y'all don't.
Kinda,
So,
like not really.
okay. So basically, you should be able to, even if you didn't have this app, you should be able to, if you know the principal and the interest, and you can look in realist in your tax section in your HAR or your board, whichever one you use, you will see the tax rate under tax information. So let's say the tax rate is 2.5%. So you take the taxes, you take the house price, you multiply it times 2.5%, and then you divide it by 12, and then
Hmm.
you take the insurance and you add you divide it by 12. You take those two numbers and add it to the principal and interest, and that's your PITI.
Boom.
So if you don't have an app, or you somewhere in that app don't pull up, and you don't want to borrow the loan officer, you guys do have the strategy. You were taught it in real estate school of how to come up with a payment. Now, do not guess on principal and interest. That's not your job. That's your job to get that number from your loan officer. So what your conversation should be like for the new people who just got in real estate, when the client comes to you and you send them to Nieesha and Nieesha says, yeah, they're qualified, they should be saying it to you. When your client calls back and says she sent me a pre-approval letter, don't start shopping from there. You should pick up the phone, ask your client, can I have permission to talk to Nieesha? They're going to say, sure. Well, can you call Nieesha and let her know? There's some questions that I should be asking Nieesha. Nieesha, what do you foresee anything that's going to keep them from qualifying for the home? Do you see their down payment and their closing costs in their bank account?
Mm.
What is the principal and interest payment on this property? Because we know one thing about that, it's not going to change, right?
Mhm.
So I can calculate the rest of it. Are we on track? If I found them a house today, how fast can you close this loan do without any problems? We need to put a good package together, Nieesha. What is the status of this client? Is this an A client, a B client, a C client? Reason I need to know that is so I can keep them on track. I can know exactly how to write this offer. And if I see the money, because we're in a season where we're writing prices over, I need to know that they got the money to do that. Because if not, if they're gonna tell me, "Oh, I'm gonna pull it out of my 401k," if you haven't already done it, we not making no offers on that.
Mhm.
So we should have a thorough conversation with Nieesha and a game plan. Because if she told her to pay that $200 a month credit card off, guess who's gonna be holding her accountable to do that? Me. So when you gonna do it? I know you got the money, but remember, they gave me permission to have a conversation with Nieesha. So I want you guys to think of it from that perspective so that you understand that yes, Nieesha plays a high part in your process. And it's a lot of stuff that we could do without necessarily talking to them. And having that pre-approval letter and having her app is a game changer. Because most times we have to call and say, "Hey, Nieesha, send me another pre-approval letter because I don't want this person to know that my client is approved for $300,000."
Mhm.
Now they got the app. That's why I want the password. I'm not even gonna talk about it. I just give me the password. I change it myself, and then we good to go. So that's a game changer. So this is a good time for you, Nieesha. I'm gonna give people more time to ask questions, but tell us about your products. Tell us about this app that you're super excited about.
Yeah. So y'all, the products are real. We have a couple of things out there right now. So if y'all haven't heard of Lock and Shop, it's one of my favorite programs. Your client can go out here into the real estate market and lock their interest rate before they have a contract on a home, right? So now Susie, Billy, Sally do not feel pressured by the market. Oh no, rates are going up. What am I going to do? They literally can lock their interest rate and go shopping up out into the market. They usually have about 90 to 120 days to find a home, and really it's 90 days to go find a home and lock their interest rate and get under contract. That's 3 months. That's a lot of time. And especially now that we have more inventory, it's a good time to go out here and find use that product. Something else that I'm really excited about is our, excuse me, so Lock and Shop, we have a Cash Edge program. Okay, y'all have heard of Ribbon, right? Ribbon is cool. I like Ribbon. Ribbon cool. But we have something called a Cash Edge product. We can do the same thing that Ribbon can do, meaning that if you wanted to have your clients offer in cash and show that it's going to offer in cash, they can do that with our Cash Edge product. So similar to Ribbon, the difference is we do not charge as much as Ribbon. Ribbon does have charges that come along with it. We do too, but ours are not as high. I think Ribbon charges 2 to 3%. We only charge 1%. And they would need to do a full underwritten credit income assets approval before they start using this product, but it's definitely an option. So if you wanted to do a comparison of, hey, I've got a client who they've got money, they've got assets, they just want to offer in cash to make themselves more competitive, Cash Edge is a really good product to use. Um, And then, of course, I'm so excited. I've got marketing now, y'all. I have a marketing coordinator. I have a marketing coordinator. Carly is awesome, meaning that she belongs to me and I belong to her. And so I'm working on marketing and doing items that are a little bit different, just so y'all can have them, and I can sponsor those. Please don't get crazy, but I'm happy to sponsor those, as long as you're making this relationship mutually beneficial for the both of us. Because, hey, girl, gotta keep a mortgage on. And then lastly, if y'all have never heard of MBS Highway, it's something that I'm really excited about, and I'd love to share it with y'all. I have a cost of waiting, right? A lot of your clients, y'all have to lead generate, okay? I have to respect that because that is hard, y'all. I come to you as a realtor and say, hey, trust me with your client. I promise I'm gonna take care of them. But you actually have to go out here and find the client, get the client, convince them to come with you and lead generate. That hustle is way different than what I have to hustle on, and I respect you. But you need tools in your pocket that gets the client to come to you. I have a product, I actually have a worksheet that can show your client what happens when you wait. It is called the cost of waiting. I sent it over to my builders this week who gave me an average sales price that they're working on. And I showed them what would happen if your client decided to wait 6 months, 1 year, 2 year, 3 years. And they're taking it out to the people who are interested in buying and showing them, you want to know what this is going to look like if you wait. Okay, this is what our estimates look like at this time. Is it 100% sure? Nope. But is it at least get a psychological movement happening in their mind? Yes. And I was actually going to bring over some of those copies tomorrow, and we can co-brand it together. So I'll show my information and you'll show yours, and they know that there is a partnership here, and you can show what the cost of waiting is. So definitely a lot to look forward to. And plus, I just love our underwriting team and how fierce we are on getting things out quickly, and so then that way you can offer a 14-day close and you can trust, like, hey, this is truly going to be a 14-day close.
So can you
Okay, I don't
explain
know
the
if you guys.
ins and out of that program? Because a lot of them don't know. Was that what you were finna say, Ray, or whoever that was talking?
No, I was about to ask her how she could get my bank statement loan down. So you can ask her when you're done with that question.
Oh my God. Okay.
So tell us how ribbon works and how tell us the ins and outs. Like, what does a client have to? What's their profile look like to qualify for it, and how does that work? Because, like Shell did mention, we are still in a market where we're having multiple offers. Don't get it mistaken. Every city and every state is not suffering, and
Mhm.
we are one of the good people. We have a great state, a great market. So, how does the ribbon work, or what is the program that you have? I'm sorry.
Yeah, it's called Cash Edge, y'all. We have a Cash Edge program. Okay, so yes, your client has to have certain qualifications in order to take care or take advantage of this program. Right? There's usually three buyer types who really like this program. The type one is someone who is ready to buy and they don't have a home to sell. The second type is someone who is ready to buy. They don't need any equity from their departing residence or anything like that. And they qualify with the departing residence. Excuse me. And the third is they're ready to buy. They need equity from their departing residents. The departing residents may not be on the market yet, but they're ready to buy because they're in a situation, right? So usually the eligible loan types and the eligible people are conventional, right? So it has to be a conventional loan. It has to be owner occupied. No, you cannot use this for your investors. And if you're an investor, I'm sorry, this is not the product for you. And the maximum loan amount is $2 million. Okay. Um, so we can do LTVs, or excuse me, down payments of 10 to 20% on these programs. It's not a requirement, but it is something to just keep in mind that there is a max down payment that you can do in order to get this product. And so I say all of that. The bar's qualifications, y'all. It has to be conventional. The minimum FICO score is 720. Their DTI has to be um, at a certain amount, right? So DTI has to be 43% or lower on a regular conforming loan, and then 40% on my jumbo loans. And if they do have a current properties to sell, please understand that there are a few more things that they have to have on top of that. Excuse me. There's a 1% origination fee on this product. I like it. Okay, Ribbon usually charges 2 to 3%, and they're gonna get a lender credit of a half of 1%, because they're gonna do permanent financing with us. So they're gonna do the cash edge product with us, but they're also gonna get their permanent financing from us and the mortgage on the back end. So please know when they finally do close on that mortgage, that they're gonna get half of that 1% origination fee. Um, Back to them at closing. Um, the other thing is, so of course I told y'all that it has to go under underwriting. There has to be a full credit income assets approval. Okay, so I can't just offer you the offer letter for cash edge until it goes to underwriting. So just keep that in mind. Once it goes to underwriting and they get that approval, then they sign off on the cash edge program agreement. They find their dream home. They send the address to me. We request a cash edge proof of funds letter that shows like, hey, they have the full funds to buy this in cash. Excuse me. Um, and then from there you go and take it out into the market, and show like, hey, they have a cash offer. Some other things that happen on the back end, pretty much, we work the market, we work the mortgage. But your client can close us if they're closing on cash, and then they're still going to work with us on the back end in order to get the mortgage.
I have a question.
Yes, ma'am.
Okay. So how does it work as far as with appraisals? If you, can you ask over asking price? How does that work?
So I haven't had anybody ask for over asking price. I've only got one or two of these out in the market right now. I would tell you to keep it as close to asking price as possible, because we are going to have to order that appraisal and make sure that the home still gets done. So once we actually send you over the letter that says that they can offer the cash, um, we get it back in the underwriting, and then we send another proof of funds letter to the customer, right? Their offer is accepted. um, and we create a cash edge loan. We disclose both loans simultaneously, so meaning that of course your client is signing off on the cash edge, but they're also working with us on the back end to close out the mortgage. We order the appraisal as soon as possible, and we finish processing and underwriting both loans. The reason why this is going to go so fast and so good is because your client already went to underwriting technically, because they got a credit income assets approval. So I would not recommend this to go like super over, because at the end of the day, the appraisal still has to happen. Um, and so that's the majority of it. Y'all are gonna close on a cash edge, but they're also gonna close with a permanent purchase loan with us on the back end. It's kind of like we're their investor, and we're showing that, hey, they have the cash to buy this home, and then we just close out their mortgage. So it should go pretty fast, where we know if the appraisal is gonna meet value.
Okay. So with the closings, you are saying that it happened at the same time. It's like with Ribbon, you have like 6 months to buy it back or to get ready to purchase it back.
Mhm.
You guys basically
We
close at
do
the same time.
45 days.
Okay. All right.
Mhm.
Thank
Okay.
you.
Uh, thank you, Benitra. Okay. Anyone else have any questions before I ask my next one? Okay. So Naisha, we are our real estate agents, and one of the things that we do as real estate agents is we make a lot of money, but we don't show a lot of money, right? So
Mhm.
we have people who have bank statement loans. What's the best strategy for the self-employed or the people who use the bank statement products to maximize in this market and lower their interest rate?
Ooh, okay. So that's a hard question, Janelle, and here's the reason why. Because bank statement loans are considered a non-QM product. Okay. What does non-QM mean for y'all? It means it's a non-qualified mortgage. Qualified mortgages can get sold to Fannie, Freddie, and entities of that sort. When a client signs up for a non-qualified mortgage, it means us as the mortgage company, someone else is privately investing in this client to have a mortgage. And so they may not get the same rates. They do not have the same options for down payment. Usually, when it comes to bank statement loans, they're going to require at least 10, usually 20% as a down payment to ensure that this client is qualified. Excuse me, their DTI has to be at a certain level. Of course, they got to show all the income on their bank statements, and it's usually about 12 months. So, Janelle, repeat to me one more time. What's your question in regards to like how to leverage that program?
So how
Let
do
me
you help?
let me ask you a question because I'm the problem. Talking about. All right, so I'm getting the bank statement loan, and the interest rate is like 6.3. That is way too high for me.
Mhm.
My credit score is like in the mid sevens, and I have like 10% debt to income. I want a lower interest rate.
I told her to
Y-
get an arm.
Yeah, I'm like that.
The problem is I don't want to file my taxes, and I don't want to raise my income. I already owe enough taxes. I don't want to pay a lot, so that's why I'm doing a bank statement loan instead of like a regular loan.
Respectfully, Donald Trump, you got to do the right thing, or you gonna get the loan product that you get. I mean, I don't. We're talking about I don't want to file my taxes. I'm
Just
sorry.
come to overflow and get an amendment done.
Wait, my
Yeah.
phone was ringing. What was the last part? My phone
Not to
started
the
ringing.
overflow.
Oh,
I'm,
Jesus. The
I'm about to be calling the overflow too. But here was my strategy for her. So I'm gonna tell y'all out loud so that maybe someone else can adopt it, or maybe Nieesha can tell me I'm crazy. So I told her to get a arm, but make sure that she in the next 3 years. So let's say she get a
Hmm.
3 year arm. She, as long as in the next 3 years she does file her taxes, which buys her time to make more money. Then she can just refi. And right now she's dating the rate. That's the same thing I said. I just
Hmm.
have a slogan for it. So I'm gonna get a lower interest rate. I have probability. I'm not gonna live there forever. Probably gonna sell it before the 3 years is even up. So why invest all of the interest in it when I might not be there in 3 years?
True that. I think that's a good strategy, right? But it sounds like Rayvon, could you get qualified for a regular mortgage if you're not filing your income on your taxes and this is what your hustle is as a broker? Because that would be my question, right? The reason why she's probably doing a bank statement is because the income isn't being filed.
She not
uh,
filing at all.
Girl.
I'm gonna file. I just don't have time to come up with everything. I have a lot that factors into filing taxes, and I just don't have time. And I need to get this house taken care of, so that's why I'm in a rush. I could qualify for whatever probably. My debt to income is super low. My credit score is high, and I make a lot of money, right? But I just don't have my taxes filed.
Which is where your program for bank statement is really good, and that's where it gets hard because when you do these programs that are non-qualified, usually the lender can offer you whatever they want to because you're not in the regular market, you've entered a whole new market,
So
and that's
bank
that's
loan is 6.3% decent, or is it high?
yes, I would tell
It is.
you in this market right now, yes, that's not too far off from the 6% that I'm offering. Um, so I wouldn't sweat too much on 6.375%, and that's probably like a $60, $70 difference.
That's what I like to hear. I just told some agent that. I don't know who I told it to, but we concentrate on it because we tell people big numbers, right? But if we just tell them the difference between where you are and where you need to be is $50, $70, it really don't seem as painful when it's painful to file your taxes, right? So
Mm-hmm.
if it's just a $7, $70 difference, $100 difference, or even a $200 difference, how many times do you go out to eat and spend $200? Just don't go that one time, but you get to have the house of your dreams. Does
Well,
that not make
the
sense?
payments ain't even the issue for me because it's definitely, I just went and got $50 of the drink mix. But at the end of the day, I don't like looking at interest rate that high. Everybody has their thing, right? That they don't like, and I've never had an interest rate over 2.9, and here I am at 6.3, and that's a hell of a jump for me.
But that's the general market right now. Everybody's at 6 and whatever percent. That's just where it is. And
If
if
I would have filed my taxes, I could have got a 5.2.
that's what I'm saying, if you file your taxes correctly, you could get a 5 point something too.
Well, just think about
Thanks
it. If
for
it's
trying to answer
scary
my
for
question.
you and you have money, for the people who barely make it, and it's terrifying for them.
Yeah, that's why I tell people to. That's what I was Shell I was talking to. I
I have
told
a
her,
question.
go ahead with your question. Go ahead.
I want to know, based on the rates, how the rates were when they were super low compared to now. What is that in a dollar amount? So I could just lead with that.
So let's use this scenario, Nieesha. It's a $300,000 house, and the payment was at 3%, and now it's at what it is right now. What was the difference?
I'm sorry, I'm goofy. Y'all, that right now, if the interest rate was 2.5% when they were first looking, and now it's at 6%, I'm talking about hundreds of dollars. It's usually on average about $250 to $300 difference in the monthly payment.
I'm
So
glad that
that's
you said
still the
that.
same. That's still the same as going to the
Six
club and buying a
thousand
bottle.
my payment to be $2,000 more.
What did she say?
I said I'm glad
She,
you said that out loud for Janelle to hear because she wants me to sell my house and go buy a 600 and something $1,000 house, and she thinks it's okay that my interest rate is 6.3.
But the difference between you and a lot of people, Rayvon, is that you probably have enough equity and enough money to put down that it's not even going to make a difference what the interest rate is for you. Your payments are still going to be low.
thank you, Naisha. That's exactly what I told her. You
She
The
over the
economy, the economy is getting bad. Janelle want me to take money, go put $300,000 down. We don't know what life is coming nowadays. We need to keep every dollar and stop saying I have money because technically, according to the recession, I ain't got nothing.
listen. I told her the same thing. She has about $300,000 worth of equity in her house. So technically, she buying her house in a different place because she only owes 200,000, right? So if
Yeah.
she just sell her house,
No,
take
it's
the
not.
300.
If my house is worth $500,000 right now, and I want to go and get a house better than mine, I'm about to be looking in like the sevens or the eights. So she thinks I got to take the 300,000 equity, add another couple $100,000 just to get my payments down when I could just get the interest down.
Mm.
So tomato, tomato, right? So
Literally, I was about to say she said the same thing in two different ways.
absolutely, tomato, tomato. So I'm saying if we coach our clients to understand the value of the opportunity, they keep looking at the dollar. Look at the value of the opportunity. The opportunity says, I, because a lot of people, what we having a problem with in real life is that people realize that this $200,000 market is now a $400,000 market. So they keep saying, and I say it too, all I get for $400,000 is this 1,200 square foot house. Well, with the house I want really costs $400,000, but the house I have, I got equity in it. I spend $200 just every day, just doing nothing. I go out to eat. I go get gas. I go to get happy hour with somebody. I have left. At the end of the day, I don't know how I do it, but I done blew $300, right? So if I just take it and put it on my house instead of just, I think of it that way. I just don't go out to eat one week.
Mhm.
Does that make sense? Right. So we really have disposable income. We just don't look at it that way because we dispose of it so much. So a lot of people are telling us, oh no, I'll just rent because I don't want my mortgage payment to be that high. Well, you just put yourself in a seat with the sharks because you don't know what your rent gonna ever be. But at least I know this one payment. I just don't go to happy hour one time. Does that not
So,
make sense?
so if I forget to refi before 3 years is up, what happens with the arm?
No, 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 no. Tell them what I told you gonna happen.
I'm asking Aisha what's gonna happen.
I told her if she does it, she lets the arm go by. That's on her. I'm gonna cuss her out because she grown. In
But
3 years, you should know. You need to put a calendar invite, something in there to know that you need to refi. And that's what we need to tell our clients too. Because
that's true. And you know
they
what? The good thing about that arm is that there's not really 3-1 arms right now. Most arms are going for 5-1, 7-1, and 10-1.
that's
So
even
meaning that the
better.
rate,
That's better.
yeah,
What does
exactly.
that mean in layman terms?
That means
So
they keep that low interest rate for 10 years and then it won't only adjust 1 point, right? That's what that means?
well, something like that, right? So 10 years fixed, and then every year after it would adjust, or maybe every 6 months it would adjust. And it can only adjust for 1 point. You're absolutely right. So
Yeah.
if I'm saying that you're going to have a 10-year fixed loan, and then it's going to start adjusting, you got 10 years, Rayvon, you got 10 years to refinance the loan. You fine.
All our lives is gonna change in 10 years. You said that? I'm gonna go buy a house now because a 10 year adjust, which means it's gonna adjust 1 point over the prime. So that's the reason why people don't like adjustment rates, Kayla. So let's say that the interest prime rate to this month is 6. So now your payment going to be 7% because it's plus one of the prime. But next month it might go down to 4%. And now your payment is 5%. So it's good and it's bad. But people use arms to buy temporary housing. And how many of you guys are selling your forever home to your clients right now? Most of these people are moving in.
Yeah.
So, and they're going to move in 10 years. So why not maximize and be in the same position? Because now we're going back into the threes and fours, or the
So
fours and low fives, right?
so how do you, let me ask the question, how do you ask the lender about the arm product? Like I know they say, oh, we have arms, but how do we get our clients qualified? That's the better question.
Gotcha. ARMs are conventional loans. So always remember that they need to qualify for a conventional loan first.
Okay.
Second of all, the honest truth, 95% of lenders, we all seeing the same thing on ARM rates. They're really not that good. So if your client was gonna do an ARM a um, versus a fixed rate, the interest rate might be the same. The better thing about an ARM is that the buy down is usually lower. So that's why a lender may try to sell it to you, okay? If if a 30-year fixed and a 5-year ARM are both offering a 5.5% interest rate, but to buy it down to 5% on an ARM costs less than it does for a 30-year fixed, I may tell your client, hey, this 5-year arm may make a difference. Okay. And that might be the better option for your client. So you can definitely ask us about arms, but you might get the same rate. And it may or may not have pros and cons in regards to, getting a lower rate. That's the only thing.
Okay. That's what I wanted to know because I had a client that was shopping around and they have a 400,000. It's a pre-approval and it's conventional.
Hmm.
So it probably something that could be good for her.
It's
Yes,
Um
worth
ma'am.
a conversation.
okay.
Hmm.
All right.
Okay, guys. So, Naisha, I heard you saying you'll see us tomorrow. That means you're our Lunch and Learn sponsor, right?
Yes, that's
So,
true.
so you will be in the office tomorrow 11. I do suggest for you guys to, especially the newer agents in the office, to come in to our lunch and learn tomorrow at 11 o'clock before we go into boot camp. Boot camp will be about profitable systems that work. But it'll be a better opportunity for you to actually co-market with some stuff with her, and she can break down some stuff. It's always better when it's in a class format. So I really do appreciate you taking the time in short notice to talk to me. It's always great. That's why I call on you because you know how to break this stuff down. And just a small plug for her. If you're ever in the marketing She has a marketing degree and she's excellent at uh, taking videos and thinking on the fly. So she's one of those lenders that don't just do loans, but she does participate in your business, which is what I love about her. So, do you guys have any questions for her? Oh, we also have a addendums class tomorrow. So, if you need some CE and you need to understand all of these new addendums plus the addendums that you guys don't use that often, our boot camp class would be an excellent one for you to attend on Thursday. Any questions for Nieesha, for me, for and the agents? Okay, did this help you guys?
Yes.
Yes.
Good deal.
Yes.
Yes.
Good deal. Well, she will continue it on tomorrow at 11 o'clock. Please come in, enjoy lunch with us, hang out. We're downtown. And I will see you guys tomorrow on the same app in the same place at 8:30.
Have a great one. Thank you.
All right. See
Thanks,
y'all
y'all.
later. Bye. Thank you,
Bye.
Naisha.
Thanks, y'all.